Thank you for tuning in to episode 235 of This Week in Real Estate, the T-Wire podcast. Broadcast live Wednesday, June 14th, 2023, the Fed's next move. This episode was brought to you by listeners and viewers like you. We don't have a Patreon or anything for you to donate to us, so just take a second, hit your share button on whatever podcatcher you're listening to, and send this to someone like you, because after all, it is people like you who make this show even possible just by listening. And of course, if you are listening or watching on YouTube, you can click the subscribe button and hit that bell so that you can be notified of when we are live and participate in the podcast chat. You can make comments and we can display those comments and talk about you, or we can talk about your comment. Just like Howard, he's already joining us there in the YouTube comments. What's up, man? He said, kick butt, Howard here. Matt LaMarche, he said he's first in English because Howard's name is in Hebrew. Well, welcome, guys. Thanks for doing that. We're also broadcasting live on Clubhouse. Let's see. We have Matt, Mike, and Scap all in the Clubhouse chat. You guys say hi if you're available. Find the unmute. Say hi. Here's your chance. Oh, okay. So they're busy.
Hi.
There it is. So it takes them a second.
That music.
you like? What's up, everybody? So you can join the conversation actually live if you join us on Clubhouse, and you can add your 2 cents that way. The podcast was created so that you could have one place to go to find the latest real estate news and headlines with a succinct professional analysis from those of us who are active in the field, just like our guest. I have I'm going to call him a special guest. He's a special guest, but he's also been with us before. So please welcome to the show, the Tim Macy. What's up, Tim?
What's up, man? It's good to be here.
Yeah, good to have you. Thanks for coming back.
Oh, always come back for This Week in Real Estate. It's the best real estate news show there is.
There you go. And we know that the last time Tim was on, it was kind of lackluster, so I brought him some help. Please welcome Matt Ferrell. What's up, Matt?
Hey, how's it going, y'all? Ray, Tim, thanks for having me on. Excited to be here.
Matt, is this your first time on any kind of podcast ever, or have you been on a podcast before?
No, this is my first time on a podcast, so
yeah,
I know.
Well, it's also a very special day. Wish Matt happy birthday. Happy birthday, Matt. Yeah.
Woo!
So Matt 29. Is an agent on my team here. Are you really turning 20? You're not 29.
29? Really? Yeah.
You're so young. So young. Matt is a kick butt agent on my team. And he's been doing this for what? 2 years or something like that. He's already closed 21 deals, closed and pendings year to date. So he's out there kicking tail, taking names. So welcome to the show, Matt. Tim is a real estate agent in San Antonio. Tim, you got a team there?
We work with Trey's team a lot, so he gets pretty much all our business.
There you go. And you're broadcasting live from a where's this dungeon that you're in?
We're at our little cottage in Massachusetts, right on the water here. So I'm gonna do this show. It's gonna be awesome, and I'm gonna go paddle around in my kayak, and then
nice.
Come back to the laptop.
Nice.
Well, this show's gonna lead right up to the Fed announcement. So we have the Fed announcement at 1:00 Central, and that is going to be taking place live. We can't broadcast the announcement, but as soon as the notes come out, CNBC will flash up their alert. Fox News will flash up their alert. Whoever flashes it up first, we'll go to that and see what the Fed does, because that's kind of been dominating the news cycle lately. And I really felt like, I guess you could say a month ago, I felt like they would raise rates because the economic news was better than expected. The economy seems to be going in the right direction, I guess you could say. But it's also still, the housing is still super inflated. And that was the one thing that Jerome Powell said he wanted to get in line, and it doesn't seem like that's lined up. So we'll see what he does. We have several articles that talk about what he could do, but we're going to kind of ignore those and go right into the regular news, because we're going to find out exactly what he's going to do. And then we could talk real quickly about what that means for us in real estate. But first up, let's talk about mortgage demand. Bring up the article here. All right, so mortgage demand surges as interest rates ease off of recent highs. The average contract interest rate for a 30-year fix was 6.77, which is down from 6.81. Applications to refi a home rose 6%, but were 41% lower than a week ago. This was the interesting stat. This is the highest increase that it's had in a long time. Applications to purchase a home increased 8% for the week, but were 27% lower than the same week a year ago. I think the year-over-year statistics on this stuff doesn't matter nearly as much as what's happening week to week. Oops, I don't want to leave the site. Oh, wow. I did one of those 2-finger things and almost left the broadcast. It seems like in our business, especially, that more and more buyers have been entering into the housing market that have been okay with getting a mortgage at this number. Would you agree, Matt?
Yeah, I think over the last few weeks, I mean, the data right there shows it, the 8% increase. But I think over the last few weeks, just in my personal business as an agent, I've seen a spike of increased buyers entering the market, people who are starting to feel more comfortable where rates are at, whether they're changing up or down. But I think just people are getting used to it. And so I think it has been showing an increase in mortgage applications. I actually had a really good conversation with a lender partner of mine yesterday, and he said that he went from basically having 1 or 2 people that he's dealing with a day that now his schedule is full and he's busy and getting to the point where he doesn't feel like he can work from home anymore and he has to go into the office. So that's good news for him, good news for buyers, good news for us as agents.
That's a funny take, because we do have a lot of people that moved here from California, and they're also being called back to the offices. So I wonder if that move back is going to create some like, oh, now I have to go back into the office. No big deal, except for my office is in California, and I moved to Arkansas to hopefully take advantage of low prices. Tim, are you seeing any kind of thing like that move in San Antonio where people are having to kind of reconfigure life around what their jobs are requiring of them?
Yeah, I mean, I think on the topic, you've got buyers that are entering the market with interest rates this high, so they don't know any different. And then you also have people just getting more comfortable with the rates. So like people who have been in the market for a little while are just kind of coming to terms with the fact that that's what they're going to get as we come into the summer market. But as far as the office situation changing, in Texas, office space is still doing pretty well. We didn't see a big dip. As someone who would love to buy an office, I was waiting for a big dip. Didn't happen. But I do think, in a lot of those coastal areas, some of those smaller towns, like I'm driving around these small towns in New England, and there's just office space vacant all over the place. And so I think it's definitely very market specific for what people are seeing around office.
And I know we've talked about that a lot. And last couple of weeks, we kind of went in depth about what's happening in the commercial product and what's going to happen coming up. And just to kind of to summarize, of all the vacancies we have, they estimate about 30% of that could be converted into residential. A vast majority of those office buildings, if not used, would have to be demoed. But last week we had Kenan on, and he said that, his coffee shops that he owns and runs and operates are near office spaces, and that the return has been really helpful for him. He doesn't really know if everyone's coming back into the office or if they're just getting out and about and going back to his coffee shops. But he has noticed an increase in traffic compared to the last year for sure. So I guess this kind of gets into the next article. The shortage of houses is hitting some people in areas harder than others. Let me share this tab and display. This one's also on CNBC. It says, even though the housing market has slowed significantly due to the rising mortgage rates, the supply of homes for sale is about half of what it was in 2019. What? Let that sink in. The supply of homes is half of what it was in 2019. And I distinctly remember being super excited in December of 2019 that housing starts were up 13%. And we finally will have some kind of reprieve from the supply issue. And then boom, COVID happened 3 months later. So I specifically remember us covering that, being like, yay, it's finally here. And now, to think back, inventory is half of what it was at that time. I didn't realize it was so low. In the balance of market supply and demand, 64% of homes should be affordable to buyers who make $100,000 a year, given the size of a population. As a result, the market currently lacks about 285,000 of those listings.
Yeah, I think new construction is such an interesting dynamic here when we look at the last couple of years, because how much COVID and supply chain stuff slowed down new construction, right? And new construction, they have to guess so much into the future that builders kind of pulled back, and then this big demand happened, and so then they were playing catch up, and then interest rates went up, and so what happened? Builders pulled back. They were looking at their numbers. They pulled back on some stuff. And now we're seeing that demand really isn't going anywhere. And so now maybe they're picking back up again. But you don't feel that pullback from builders until 6-7 months later, because that's when you should have had inventory hitting the market. That's not hitting the market. We're actually investing in a project that a builder pulled out of. And, the group that I'm working with is picking up the land just to sell it back to the builder because they're looking to build because they know they need inventory again. So the whole new construction thing is super interesting.
So wait a minute. There was a project that a builder pulled out of and now is buying back?
Yeah, I mean,
in order to start to build on it?
All these different land deals in Texas. And so what happens is big home builder is buying the land. They're under contract on the land. Interest rates go up. Who knows what's going on with the market? They bail. We swoop in, grab the land and get it under contract. So we'll, do the platting, the mud and the, utility district and all that other stuff, knowing that the builder's kicking themselves for pulling out of it. And they're just going to buy it back when all the development side of it's done.
That's so smart.
Yeah.
Yeah, it's really smart.
Here's a quote from Realtor.com's chief economist, Danielle Hell. She says, ongoing housing costs and the scarcity of available homes continues to be present budget challenge for many of the prospective buyers. And it's likely keeping some buyers in the rental market or on the sidelines, delaying their purchase until conditions improve. What do you think, Matt?
Yeah, I think that it's an interesting time for people who are looking to buy. Like I'm going to use me for an example, right? And my kind of demographic. So I'm a guy in my 20s, married, no kids yet. And our household income is, right around that 100,000 that the article from CNBC mentioned, right? And so there's a huge shortage in homes that are available, but you see, and later down in the article, they talk about, you see that the homes under 500,000 are selling really fast. Well, for me, that's not even something that I can necessarily get pre-approved for or afford where we're sitting at. So we need those homes to be even lower. Well, what's happening with those homes? They're selling either to an investor who's looking to rent out the property and they're selling really fast, or it's selling fast on the market because it's the only demand level that, as far as price range, that's available for people that are in similar demographic as I am. So I think it's just they put it perfectly. It's like a tale of two cities, and really a tale of two purchasing powers, and tale of two types of buyers. And so I think that even though, and I know we're going to get into it later more in depth, that like the rent rates have dipped in certain areas, I think that you're going to see more people still chasing after rents just because we're not having an increase in inventory that fits specifically the market of people who are in my style of demographic, that 70 to 140,000 annual income for a shared income for a family. It's just hard to find a home in that range.
Yeah, and builders aren't building there because they can't make the money that they can make in the other price ranges. So until that changes, and it does say in the article that some builders are starting to give more incentives, but that's in the upper price range still. So there's still
I think it said like over 500,000. They're starting to realize it, but even then at that point, they're realizing that because they have such a high demand with the shortage, now they can be more strict on what incentives they're giving. They don't just have to give away everything.
Yeah. I think we've been in a reverse domino since, let's see, when was that? Do you remember, Tim, was it 2018 or 2019 when Steve Harney spoke at the Tom Ferry conference? He's an economist for KCM, and he said, if the price isn't compelling, the home is not selling. Do you remember that?
Yeah.
So I want to say that was in 2018-ish, maybe even 2017 when he said that. And he talked about the reverse domino that year, how for years and years and years, it was a situation in which someone would graduate college, get married, buy your first home. It was a little bitty starter home. And then you would sell that whenever you were trying to
Move
Matt
up.
Lamarche just said, stop buying your avocado toast, Matt. Then you can afford those higher price. But anyway, people would move up into the next house and then they would sell their previous home. Then they would move up into the next house, sell the previous home, then move up into a house in which is a big one. They stay there for a long time and then they downsize and sell that one when the family's gone. For years, that was the pattern that everyone followed. Then all of a sudden, Matt's generation came around and they didn't buy a house. They got married and they stayed mobile. And I should say I'm the oldest part of that generation. So it's in part my generation too. And we didn't buy, you know, our first house is one that we're going to be in for a long time. And we didn't buy until we were in our 30s. And so that pattern totally stopped. And when that pattern stopped, now in order to get the people's attention to move up from this mid-range into the luxury market, there were so many luxury listings. I can remember doing analysis for a property and I told them, I was like, there's 24 months of supply for a home like yours. And they're like, what? There was 24 months. There was 2 years of supply for a luxury home. And I told them what Steve said, if the price is not compelling, the home is not selling. You have to make that luxury home priced at a price that pulls up someone that was like, ooh, I wasn't looking, but if that's the deal I could get, I'm interested now. So the compelling price pulls people up into that other price range because I don't think people are into just having a big house in order to have a big house anymore. And so that reverse domino is what's happening. When that person is pulled up into that luxury price range, now they're willing to sell this house that they were going to keep for years and years. And then when they sell that one, that price has to be compelling enough to pull them up. But right now, the market is different. When Steve initially said that, it's still a domino effect. I still see that pull. However, it's because of the low interest rates. If the price is not compelling in that luxury home, someone is not going to trade their 2% interest rate for a 7% interest rate. And so now the compulsion has to be such a good deal in that luxury home that I'm willing to give up my 2% rate, or I'm willing to not have to keep my house and put it back on the market and not rent it out to someone. So it's the same effect, but for a different cause, if that makes sense.
Well, we've been buying, fixing it up, living in it for 2-3 years and buying the next one for the last, I don't know, 8 years or so. And we're in our third house in San Antonio. And like, it's getting to be about that time where I would, you know, we've got some equity and everything. Let's roll it into the next house and let's keep this thing rolling. But when you look at the mortgage payment difference on
Yeah.
rolling into the next house, it makes no sense, you know?
Yeah.
And so definitely interest rates are keeping us kind of where we're at. I know that's the case with a lot of buyers.
Yeah, I wonder if we're going to see a massive increase in cash purchases. Matt Lamar says, "You kids, it's actually the $7 lattes. Are they only 7? I think they're 8. I think they're 8 now."
Oh my God. Yeah.
The neighborhood seller said, "I did the same thing, Ray. I purchased in the 30s and didn't plan on selling." Yeah, I mean, especially for the rate we have now, it's you know, it's 2 points something. I'm going to keep this thing as long as possible.
Yeah, because of the rate, I'll probably end up renting out. I don't want to ever get rid of that house.
Yep. The next article is kind of interesting. Luxury condos. If we have anyone listening that is a specialist in luxury condos, I would love for you to chime up. This is on Redfin, and they said, why are so many luxury condos built in cities that face an affordable housing crisis? And the most interesting part of this was actually the story they talked about. That was kind of like the anecdotal story of this person that opens up a restaurant in a beach area, and the city said you can only serve 50 people at a time. And they're like, okay, that's fine. If I can serve 50 people at a time, I'm going to do lobster and steak. And so they do lobster and steak, and the city gets complaints because the people can't afford the lobster and steak restaurant across on the beaches. So now they're forced to offer more affordable options on their menu. So then they have like a bar top type menu. And so it's only available at the bar. So all the quote unquote wealthy people go get seated for their lobster and steak. And there's a line of people at the bar for the more affordable option. That becomes a problem. So people start complaining about the lines. And so it's just like one thing after another with all this city regulation for this little restaurant that just wanted to open on the beach. And it's creating an environment which kind of the regulation is continuing to cause the issue. But they talked about that is the illustration of what's happening for the luxury condos on the beach. As people are putting these luxury developments in place, even the people that work at them have to live so far away because they can't afford anything even closer, because as they put the next luxury place in, then it doesn't do anything but increase property prices. And they said that whenever a new development comes in, brand new luxury condo, that it makes the affordable development the one that was developed several years ago. So now it's not like there's no affordable developments being built. It's just that the old luxury is becoming more affordable, but it's still not that affordable. It also talked about the cost of developing, supply issues, and all that stuff. But I just wondered if there was anyone out there that could comment, or if you're watching this on the replay, I'd love to hear what people are doing who live in or work in the luxury condo areas, and specifically the old ones. There were stories talking about Florida specifically, how they have new rules in which they're going to have to go through and renovate a lot of those old condos. And I feel like it could be I don't know. I feel like there's something weird going on in the condo market. So I wanted to get somebody to speak to it. But Tim, have you invested in any of those yet?
I haven't bought any condos. It's actually like the one thing I stay away from is condos on the investing side. But I do, I would love to hear if somebody has some input on this, because I do believe that the condo collapse there that happened in Florida likely put in a ton of new regs and restrictions, and made the cost of owning one and made the cost of building one a lot more. Which, look, I mean, safety regulations, it is what it is. We got to have them. But it's funny. I mean, I think a lot of these states, a lot of these cities and everything have these economic incentives to allow for affordable housing. So, hey, if you give a certain amount of your units, make them affordable, we'll give you some tax break. And, if you can make those numbers work, then fine. But when you look at just how much this coastline stuff is going up and how much more you can sell it for, I think it's probably just a math issue. Like, the incentives to build affordable aren't enough to make developers do it. I mean, it usually ends up being just numbers on a spreadsheet, and that's probably what we're looking at.
In the bottom of the article, they talked about the increased supply being a solution, and it said Montana. Now Montana is not a place where I think of high-rise condos. Montana, which has been an influx of home buyers from pricey coastal metros, got ahead of the housing scarcity problem. In April, they voted to legalize dense housing, mixed-use buildings, and commercial zones. Legalized ADUs, the accessory dwelling units that we talked about like last week with the Home Depot tiny home. And any lot with detached house. They legalized duplexes on every residential lot, limiting the parking mandates to no more than one space per home, and accelerated the permit review process. In Montana. Now, in my head, I'm thinking like Montana, everything should be like spread out. And here they are saying, no, we can all bunch up. Let's all bring it in. I just think that's an interesting contradiction to what I picture in Montana in my head.
Well, yeah, seems like they're doing. Go ahead.
I think you see a lot of the higher regulated areas and higher regulated things like condos have more inventory problems, and it's like they want to regulate a problem that the problem is it's overregulated. So it's like let's lessen some regulations, because that's the only way you're going to get increased supply, is if somehow you make the process easier to build.
Yeah, that would be true. Montana, I could say, is a deregulation. They're not necessarily going to build high rises all over the place, but I could definitely see them being like, we don't want no regulation.
Yeah.
Yeah, that's what I was going to say it was going to be on that same beat, that it seems like Montana is going in that direction, or at least with this information presented, that if we can deregulate some things, we can probably increase the population that comes here, maybe moves from out of state to a place like Montana. And at the end of the day, if we lower the restrictions on getting people in, well, that can only help increase the economy in other directions. So I could see that where that's the play they're going for.
Now, I know some of you out there are thinking, well, we could just buy one of those old luxury condos, and now we have something that we can rent out to a bunch of people. Maybe. It seems like rent prices or rent rates are actually going down. So the rental market tracker asking rents fall 2% in the West, but rise 5% in the Northeast and Midwest. So the nationwide rents declined 1% from a year earlier in May, the largest drop since 2020, as a building boom increased supply and economic uncertainty cooled demand. So this is on Redfin. Let me zoom into this. Always like the charts. I'll zoom into the chart. All right, so this chart is showing in February of 2020, it was at negative 1%, and then it steadily went up to where February of 2022 was a plus 17.5%. And since then, it has steadily declined back down to negative 0.6% in May, which is about negative 1. Do you see any slowdown in investment happening because of rent rates?
Scroll down. Like, this is the real graph, right? They're like, oh, it's dropped the most that it has since 2020. And if you look, it's still ridiculously increased since 2020.
That's a great segue. I mean, when you look at the percent change over time, this looks like you're back down to where it was in 2020. But as Tim said, when you look at
way up.
When you look at what the actual rent was in February of 2020, it was just under $1,600, and now it's $1,995. That sounds like a late night television. $1,995. But wait, there's more. So it still seems like rents are super high. But do you see anyone backing off from the investment game due to this changes in rents, or are they looking at these long term and kind of ignoring the temporary ups and downs?
I mean, the pullback on rental real estate is the interest rates. So, when you take the interest rates that have gone up, plus property values have gone up. So when you're in a high tax rate state, high property tax state, then, you've got your cost to own that property is significantly higher, which makes cash flow a lot tougher. So I think the slowdown if there is a slowdown on buying investment properties, is more from the aspect of interest rates and property taxes, not rent rates, because rent rates are up. My rough math tells me 25% they're up since that 2019, 2020. So the rents are still good, but the cost to own the rental is much higher. Cost to renovate it, cost to maintain it, like the costs associated with it is higher, but the rent rates themselves are great.
Yeah, we are seeing a lot of people. What did that come from? There may have been some echo in my mic. We are seeing. Can you hear that?
Yeah, somebody calling in.
Oh, that was on Clubhouse. There it was. Sorry, it was playing differently in my ears. Let me turn that down. Sorry about that. I was like, what was that?
Quick,
go ahead.
It isn't the older luxury renovation. It is the insurance that has gone up so much, which makes the HOA like it out of sight. So that's the problem with the luxury condos.
And correct me on the Florida condos, the insurance rates are lower on the newer condos because they're built to higher standards for all the storms. So the older condos are almost like impossible to get good insurance rates unless you want to build a new one.
Right. So if you renovate it, you still have that really high, insurance rate. Plus, if people had low or no, I'm trying to think of the word, reserves, they now by 2025 have to have reserves. So they're added on. So but for a Section 8 in, just as an example, in Fort Lauderdale, they get $3,000.
Wow. But that not only does that cover rate, that is a partial voucher for utilities as well.
I don't.
Yeah, I think it is in our area.
Okay, well, they only have to pay 30%. Okay, of that 3,000 plus what I understand. They can have a bank account, and if they want to, say something costs $3,500, if they have the extra money, they can add it to their voucher as long as it's disclosed.
Interesting.
Yeah, we have a lot more Section 8 investors than we've ever had. So we are getting that call a lot. Let's see. Something happened to Matt. He got booted. So we're going to try to figure out how to get him back in. Tim, you didn't notice anything glitch on the stream or anything, did you?
No, we've been good. My middle of nowhere Wi-Fi has been holding up.
He just sent a picture of him waiting, and it says it won't let him in. It just shows connecting ... Okay,
Yeah.
let me see. I'm going to remove your producer and see if there's some kind of unlimit or something. All right, let's see. Try again. All right, we'll get it figured out. A little technical
Tell them
difficulty.
to go to Clubhouse.
Say again?
Go on a Clubhouse.
Clubhouse.
Yeah. I don't know if he's been in Clubhouse for a minute. And that's Mia, by the way. Thanks for joining, Mia. Okay, so next, inflation is falling. So what happens next? Here's what most economists are saying. Let me share this tab here. There we go. So this one goes a little bit into what the Fed may do, but more important, like what are we watching here? So the CPI rose 0.1% in May, according to the data released Tuesday by the Bureau of Labor Statistics. At 4%, the annual increase in the CPI in May was less than half of the 8.6% annual increase seen during the same month a year ago. So the CPI is a consumer price index. So that's good that it's still going up, but not going up as much as it was. The steep rise in housing costs is chief among the expenses, keeping inflation high. But Tuesday's data shows prices declining for the second straight month. I just heard him. Oh, but he's not here yet. I got the little ping ping that you should be here, Matt, but I don't see you. Sorry, I'm going to keep going. Shelter is still playing a big... What'd you say, Matt?
I said, I'm here. I don't know why I'm not showing up.
Different Matt.
Oh, sorry.
Shelter is playing a big role in inflation, but should be slowing in half of the second year, said Jason Furman. He's a former director of the National Economic Council of the United States and professor of economics at Harvard. He says, quote, the last 2 months of inflation has propped up by the used car prices, which should be reversing. Have you seen used car? Have you been in? Are you in the market? Are you trying to find a ride?
I sold my car, actually.
Yeah, take advantage of that.
Yeah. It a little softer than it was, a year ago. A year ago it was a little crazier, but I think the car market's still going strong.
There you go. Yay, Matt's back.
There he is. My stepfather's actually over here. He's in cars. Let's bring him on. Just kidding.
Yeah, let's bring on the stepfather. Well, I have what's funny about all that stuff is that one of the reasons why the used car prices went through the roof is because they couldn't build new cars fast enough. One of the reasons they couldn't build new cars fast enough because the shortage of microchips. And don't forget to get your vaccine, everybody. I'm not saying those are connected. I'm just saying. You remember the whole conspiracy theory back in the day that microchips were in your vaccine? That's when they came out.
Man. All
That's
right.
when they came out. When,
that's a side road I have not gone down.
You have it? Oh, it's funny.
No.
It's funny. But then they came out and said like that next month that there was a shortage of microchips for cars. And so people were really flipping out. It's funny.
I love a good conspiracy.
Yeah, it's almost like they orchestrated those news stories. Let me share this tab too. This is on the same topic, so we're not going to spend that much time on it, but why economists say it's near certainty that housing inflation will soon fall. So inflation and housing falling doesn't necessarily look like a 10% correction, which is what the Fed chair said he wanted in housing. It doesn't necessarily mean prices are going down, but what it does mean is that prices will be going up at a rate that matches normal inflation. So a reversal of the inflation that we've had means that home prices should only be going up 3 to 6% a year, depending on the areas. That's about normal. And so right now, the consumer price index is right around 4%, it looks like. Less food and energy, it's 5.3%. And then it talks about how shelter prices have changed a significant slowdown from the 15.7% growth during the prior year, May of 2021 to May of 2022. Now it's only 4.8%. That's a huge difference. So I think with that, we may see that the Fed doesn't do anything. He's got 15 minutes, and we'll cover him live. But there's something else happened. There's something else brewing, I guess you could say, and this is among the iBuyers. Does San Antonio have iBuyers?
Oh yeah, I've dealt with them a bunch.
Is Offerpad there?
Offerpad's there, yeah.
Not for long. No, I'm kidding. Sorry.
It might not be.
Yeah. So Offerpad executes a 1-for-15 reverse stock split to head off delisting. They're in bad shape.
1 for 15 is not a small number.
No. With the approval of shareholders, struggling iBuyer Offerpad will execute a reverse stock split Monday in a bid to save the company from being delisted from the New York Stock Exchange. Offerpad received a non-compliance notice for going under $1. If you go under $1 for 30 consecutive days, you get the non-compliance. Shares of Offerpad briefly surged above $1 in February after the company announced a plan to raise $90 million from existing investors, including the CEO. But shares in the pioneering iBuyer failed to maintain a minimum of $1 average over 30 trading days. Where does the disbelief come from in the iBuying model?
Yeah, I mean, the problem with the iBuying model is that, you know, they look at these big tech companies that can grab a bunch of market share and make a little bit on each deal. So think, you know, scale, smaller percentage per deal, but do a lot more deals. And the housing is just too nasty of a beast. Anybody who's flipped a house before knows that those numbers you estimate are rarely accurate. And to try to play a 5% game, like make 5% of your money on a property or 10%, one plumbing issue will ruin that for you. 30 more, 60 more days on market will ruin that for you. And so the iBuyers started at the best time in history for them to start, right? Which was like 17, 18, 19. And they rolled into 2020 and had this market that just kept going up. So even if they messed up, they still made money. Like the market kept saving their poor buying choices. And then the market pulls back and they're done. Like there's nothing there. They're all, they're all drowning.
But you wouldn't say it's a risky investment, would you?
iBuyer?
No, I mean just real estate in general.
Well,
like if you take the thought process that
if you watch
iBuyers are investing in real estate.
If you watch my Instagram reel that I just posted today,
you posted a video?
Soft plug. The most important thing you can do is make your money when you buy. Sure, investing in real estate is great, but not enough people talk about all the people that lose money trying to invest in real estate. I deal with people all the time that lose money investing in real estate, and it's because
you heard it here first. All of Tim's investors lose money in real estate. Yeah, I deal with guys all the time that are losing money.
I'll be honest, like, they're like, hey, I want to get into real estate investing. They find some agent, they go buy a house, they realize they paid too much for it. They realize there's all this stuff going on. They look on YouTube, they see me, and they call me. So like I get these phone calls halfway through the process of what's going on. And so I mean, a lot of people lose money in real estate. I think real estate is a great long-term investment, but it's not an easy game to play to flip houses. And every house is so unique, is so different that it's hard to plug it into an algorithm and figure out how much you should buy it for.
Yeah.
I mean, I've sold houses these guys are right. You literally take a video walkthrough and you send it to them. That's all they do. And then they buy the house. There's no like full inspection. They don't know if the foundation's off. They don't know if it needs a new roof. They don't really know, they don't see like if there's a leak under the water heater. Like there's so much stuff that they can't know just from getting some videos and some pictures. Like you have to inspect the house before you buy it. And they're not really doing that.
What they do is say, okay, if we buy 1,000 homes.
Yeah.
We know that those 1,000 homes are going to have an average of $5,000 in repairs per home. So we're going to need this amount of money set aside, and we'll have a little buffer there too. Okay, with that in mind, then we can buy at this price. And I remember when this was happening, our rationalization for why Offerpad and what's the other one? Open Door.
Open Door is the big one, yeah. And
Our
Zillow, when they were doing-
rationalization for why they were willing to pay so much more than market value was because, well, maybe they have an algorithm that tells them it's going to sell for way over that price. And when it sells for way over that price, then they're going to make their money back because it's a hot market and they're going to make a ton of money in the market. But what we saw over and over with their earnings reports is that they were all losing money in the best possible market to become an iBuyer.
Yep.
So I think, I mean, needless to say, they never opened in our market.
And I don't want to stick on it too much, but I can tell you, like, they probably did the math where they're like, hey, 5% of the deals we get are going to be losers, but 95% of them will be great. We'll make money. And I can tell you, for me, I'd go into my listing and I'm like, this is that 5% that they're going to overpay for. I can tell, like, older part of the neighborhood, but they're going to pull comps from the old neighborhood. Floor plan doesn't work. Their algorithm's not going to tell them that. Like, all they bought were the 5% losers because that's what they were overpaying for.
Yeah, that's so interesting. Matt, are you seeing anything with our investors? We don't have any iBuyers. We do have people that would pay cash, but I feel like the numbers that they're asking us to get on these houses are like ridiculous. Like, I would buy it for that.
Yeah, no, for sure. I think it just depends on the investor, where they're at in their investment career. But I agree with Tim when he's saying, because it's just an algorithm, they're missing out on the actual, I don't know the best way to put it, but they're just missing out on that human element of having the ability to see the home for what it is, go in, know exactly why the home is priced this way, not just because an algorithm is telling you it is. I think there's a huge, again, I think that because they got, like, iBuyers tried to take off during the time when they should have been super successful. And we've now seen things through Zillow over these past few months. Now we've got the Offerpad, having to try and scramble to stay listed on the NASDAQ. Like, it's just showing that the human interaction is so important in real estate, because it is. I mean, I think it's like, we're 10 years in now that it's been voted the best long-term investment year over year. I think it's like 10 consecutive years or whatever, from Forbes or whatever it was that I recently saw. And it's like, yeah, it is. But if you're just going in, like you said, Tim, looking at a video and going, okay, well, that looks fine, and the number says I can do it and I know I can do it. Yeah, you're going to strike gold every so often, but how many times are you going to, hit coal instead of gold? Probably more often than not. And so you're getting these investors who are losing money and now thinking, well, maybe this isn't the best idea. But I mean, Tim, you're an agent and you have investment properties. You can see firsthand, yeah, it is good if you know what you're doing. And I'm not relying on an algorithm to tell me what I'm doing.
I feel like it's hard to make a short-term gain in a long-term game, because everyone else playing the game is playing long-term. Like, the people that are willing to bid against you to buy that investment property are going to stay there for 2 years and do the stuff themselves and flip it in a ton of markets. So that relegates an investor who's trying to make money by not living there. He's not willing to take the risk. So he's not willing to, a lot of people that are, I call them owner occupant investors, that are buying a house, living there for 2 years and selling it like Tim does. The owner occupant investors are willing to pay a little more because they actually want to live there. And they look at the benefit of living there like something worth paying for apart from the investment itself. So while they may be more conscientious of the numbers, they're still willing to pay more than a regular investor would, for the most part. And so an investor gets beat out by the owner occupant investor. So then what is the investor left with? A lot of properties that most people don't want to live in. So it's set up to be a more difficult game for the investor, but I think you can play it well. You just have to have a team. You have to have the right people to talk. Well, I mean, that's why you should just call me.
I could do a whole show on the 4 boxes of investing and like where people need to find their competitive advantage to play and all that fun stuff.
This is what we were talking about with the Offerpad. For the audio listeners, I'm showing a picture that shows the net income and revenue of Offerpad from 2020 Q1 there. They made 367 million and they had an 11 million loss. And they go all the way to Q4 of 2021. Was it Q4? No, Q1 of 2022. They made $1.3 billion and their income off of $1.3 billion was 41 million.
Look, I'm not an expert on this stuff, but I think that some of the iBuying companies were booking stuff in a interesting way to make revenue very high, to drive stock price. I'm not an expert, but 1.3 billion sounds like they bought a house for 500 grand. They sold it for 500 grand, and that's $1 million. That's $1 million in revenue or something, you know?
Yeah. That they Q1 of 2023 is 609 million, and they made negative 59 million. So there's still bleeding money. Wasn't this the group, the one that's supposed to partner with Zillow when Zillow gave up their offers platform?
I think so. I'm pretty sure it was Offerpad, Open Door. Listen, one thing on the iBuyers though is that they were trying to make it a smoother process for the consumer. And I believe that that should be the goal of all of us. And so my sellers that did sell to Open Door, they loved it. It was easy for them. They got a good amount of money for their house. They could move out whenever they wanted. And it was simple. So like they had a good product in that regard. They just, didn't make the numbers work.
I'm going to real quickly cover these next two because then we have an announcement. Actually, I'll just real quickly cover this next one.
You need a timer up there. It says time to announcement.
A countdown to the Fed. Oh, see, maybe I'll do that someday. I don't know. I got to figure out how to do that on redlining. Is that still a thing in real estate? It says this opinion piece is on Inman. It says it is. Redlining and steering continue to plague housing. So where's NAR? The general premise, let me read a couple of these paragraphs here. National Association of Realtors is backing its members, but sadly it's failing homeowners. And based on its lack of action, it seems to lack a desire to create meaningful change. It's a good time to work at NAR. However, in sharp contrast, Rick Riley, NAR membership policy and board, blah, 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 which oversees NAR membership requirements, said of last month, it's a great day for fair housing. Talking about some of the discriminatory suits and everything that have gone through and been settled. Where's the one that they actually get to the allegations here? Officially NAR.
Yeah.
All right. So NAR and racism.
The Long Island stuff.
NAR and racism have a long history. Yes. Okay. Long Island divided. Yeah, that's it. So this was from 2019.
Yeah.
Immediately after Adam Ruin's video was released, Newsday released the amazingly shocking and appalling Long Island, New York investigation, which revealed the news story that broke in 2019, where investigators used paired testing, sending two different people to the same real estate agent. One of them was white, one of them was a minority. 49% of cases, African-American home buyers were shown fewer listings and steered away from white neighborhoods. It doesn't really, that's really what it talks about. And it kind of goes into some detail of that. And then it just talks about some anecdotal stuff here and there. I read this, and after reading it, my thought was, well, what a good graphic at the top to get people's attention. I didn't really feel like this had any meat. Did you guys? Am I not looking at this correctly?
I mean, I don't disagree with the story that, this study was done in Long Island, which was pretty, rough results. Like those agents did not look too good after
they look terrible
digging through that. But I think it points to the fact that like NAR doesn't really do that much. Like NAR is in the business of having more members and driving revenue by having more members. And in actuality, like if they're actually going to do what they're supposed to do, it's like how many of those people in that Long Island report are no longer agents because NAR came down and said we can't have this. Like I'm pretty sure none of them, And so it's like if NAR says that they are who they say they are, like they should be in the business of removing agents from the Association of Realtors as much as they're focused on adding more.
Yeah.
Yeah.
Look, I mean, we've all dealt with crappy agents. Imagine if NAR was actually an organization that looked into crappy agents that are doing awful things and actually removed them from the Association of Realtors. Like that would instantly make what they
Imagine.
talk about a lot more valuable.
Imagine if they held to a standard.
Yeah.
Well, usually what they go after is the politically easy targets. That's what
I
I've
think
seen.
Ray, I'm not a big NAR fan, but
Yeah.
I will say like the political stuff is what they should focus on doing, and then also trying to raise the standards for agents. And I can tell you what I don't believe is going to raise the standard. Continuing education.
I mean, 2 hours though. You got 2 more hours. This article says of that kind of education that's supposed to help eradicate this issue.
Yeah. It will have a couple of slides to click through on a Tuesday morning. Will have zero impact on what agents do in their business.
Yeah.
It's stupid. Sorry.
Mm.
The
Very
new
bad.
policy states that the ANAR requires 2 hours of fair housing training for new member applicants and on a recurring basis for existing members every 3 years, coinciding with the code of ethics training. I just don't, number one, I don't think the steering issue is what it was for sure. Now, lenders, right now, I have a current issue where a lender is putting some irrational, I'm going to say unusual. They're putting some unusual standards on a property that no other property that I've dealt with has had. And the buyer is using a down payment assistance that does not require a more rigorous test of the condition of the property. The appraiser has been out there and has not noted any condition of the property issues. The buyer wants to buy it, fix it up, and it'll be a future investment for them. And they are a minority. But it seems like there's a lot of red tape. I'm not going to say red line. There's a lot of red tape that the client is having to jump through that I haven't ever had another client have to jump through.
Yeah.
So I think that kind of stuff is kind of how it happens now. It's less of an agent saying, "Oh, you don't want to live in that area." I mean, that's pretty. I guess there are some agents that do that, but that's pretty ignorant and bold and ridiculous.
Yeah.
But 2 hours of continuing education every 3 years is not going to fix that.
No, I mean it's ridiculous. It doesn't fix anything.
You actually have to find people.
Yeah.
I'd also be interested in seeing, just because I'm the type of person that really likes to see what drives data and like what actually caused the result of it. So I'd be interested to see out of those 40 something, I don't remember what the exact number was from the article, interactions, how many of them that ended up, falling, prey to ignorance with their own redlining-esque decisions came from actually just like, hey, we got a pre-approval from your lender. It said you're in this $100,000 to $200,000 price range is what we're shooting for. Here's the 20 homes because there's a lack of inventory that are in that price range. The client says, well, I want to see a $300,000 home. And the agent was like, I mean, I can show you it, but there's really no reason if that's not where you're going to be comfortable with your mortgage and you're not pre-approved up to it. And then that's when that client, who obviously, like they said, they sent these clients in, is like, gotcha. Like, you didn't show me this neighborhood because you don't think I should live there. You know what I mean? And like, obviously you hope that's not what it is, but I'm always interested in case studies where it's like, what got them to that exact moment. I like seeing that exact type of data set.
What did actually cause that exact? Yeah, I agree.
Yeah.
And the chat may not be displaying. Hang on. Let me test this real quick. Yeah, the chat may not be displaying. So sorry, YouTubers, if I didn't display your comments today. However, guess what? Breaking news from this week in real estate. The Fed pauses. There's no rate increase. Washington, Dateline. The Federal Reserve on Wednesday decided against what would have been its 11th consecutive interest rate increase as it measures what the impacts have been from the previous 10. So they've decided against raising anything or changing anything. But the decision by the Fed Open Market Committee to hold off on the rate hike meeting came with a projection that another 2-quarter interest rate percentage point moves are on the way before the end of the year. So that's kind of what I said a month ago. I think they're going to raise rates, but if they don't do it this time, they'll have to raise it twice. And I think that's what they're going to do. The Canadian Fed paused 2 months ago, and then this last week, they increased it 25 basis points. So the Fed, when they paused, we raised it, we increased it. And so there was some speculation that they would pause this time, but Canada says that pause didn't work for them. Let me see if there's any. Holding the target range steady at this meeting allows the committee to assess additional information and its implications for monetary policy. Let's see, looking through this breaking news for any kind of quote. Fed officials believe the policy moves work with, quote, long and variable lags, meaning that it takes time for rates to work their way through the economy.
Yeah, I do agree there. It's like you raise rates and want to see instant results, like the inflationary situation we're in took us years to get into. It's going to take us a little while to get out of it.
So does this mean that we're gonna see 5.5% interest rates in the next couple of months?
It'd be great.
78% of buyers are waiting for 5.5% before they make a purchase.
Yeah, I think 5. If we can get to 5.5, that's going to be a much better number for buyers. The question though is, will we get to 5.5? Will it be a much better number for sellers who are at that 3%?
Yeah, would it be much more for them to stomach? Yeah,
because if we just get more buyers in the market, that doesn't really solve our problems.
No. If anything, that's going to make all these, and that's one of the things we've been telling our clients is, they're kind of measuring like, should we wait on rates to drop? We think they're going to drop. Like, yeah, you can wait, but it's one poison or the other. Either you buy at 7 and you get a good deal because the property's on the market. Maybe it's lagging on the market. You can kind of go under because a lot of buyers have pulled out because of the 7%, or you wait and buy at 5.5. Or you wait and buy at 5.5 and be prepared for the price to be like, just like it was in 2021, just going up and away.
Or like me.
I agree with you.
Mia agrees with me. So there you go.
Like I'm under contract on a property up the street from here, and it's a fixer upper. They got to replat it and do all sorts of fun stuff. So I'm like, look, I'm just tying it up, just getting under contract in today's market. That way I'm locked in at this price and hopefully get tomorrow's interest rate if it comes down.
Maybe it'll come
I
down.
don't care if it takes them 6 months to figure out their stuff and close on it. I just like getting it tied up at today's price.
Well, if you're watching live or on the replay, drop us a comment. Let us know what you think this Fed move is going to do, if it's going to be beneficial to you, if it's going to hurt your market, what's going to happen. But in the meantime, Tim, can you tell everybody where they can find you?
The Gram. I think the Gram is probably the best place to connect at Tim Macy Realtor.
At Tim Macy Realtor. And what about you, Matthew?
Yeah, Instagram at Real Matt Ferrell. Easiest place to find me.
At Real Matt Ferrell. And I am at Razorback. That's RAYZORBACK. Thanks everybody for listening and watching. Thank you so much for commenting. Don't forget to subscribe, hit the bell so that you can be notified of shows like this when they're live. And also we have a special coming up in which I will be taking on the Zillow ChatGPT bot. And we're going to be testing it out live so everybody can see how it works. So I'll see everybody next time. Thanks for joining.